Hello and welcome to the Saturday special episode of the Daily Brief, which we call the Weekly Brief. Now, we've been experimenting with this Saturday special show quite a bit. Last week, my colleague Bhuvanesh tried something out, and most of you all had positive things to say about it. Therefore, we're trying to revamp the weekly show accordingly, and we'll be back next week. Until then, we've compiled some of our favorite stories from throughout the week, so I hope you like it. Let's talk about oil and whether it is telling us something about the global economy. Look, crude oil prices have crashed to 9-month lows right now. WTI crude has fallen about 6.48% and Brent has fallen over 4% in the past 5 days. Brent is now trading just above $73 a barrel, which has erased all of the year's gains. Javier Blas, the commodities columnist at Bloomberg, pointed out something very interesting on Twitter. He said that adjusted by cumulative inflation, oil prices are now at the same level as they were 20 years ago. Because of this, OPEC Plus countries are suffering a huge drop in purchasing power, with an oil barrel buying fewer and fewer manufacturers and services. That is a stunning change because in 2022, crude was at $120 after Russia had invaded Ukraine. Now, the reasons for the fall in oil prices are related to both demand and supply. The demand concerns are that China's economy is slowing down significantly and has signs of weaknesses. Factory activity has fallen 4 straight months, and at the same time, the value of new home sales is declining. The real estate sector in China is one of the biggest users of diesel. Chinese oil imports have dropped substantially right now, with July and August seeing 800,000 fewer barrels per day compared to last year. Chinese refineries are currently operating at much lower rates, with Q3 throughputs expected to be well below last year's levels. The economic slowdown is not limited to China, by the way. The US manufacturing sector is also struggling quite badly and has contracted for 5 consecutive months now. This has led to fears of a broader global economic slowdown that could further reduce oil demand. Talking about supply issues, earlier this week I had spoken about the internal conflict in Libya, which has led to the shutdown of oil production. But this crisis appears to be nearing a resolution right now. This development could bring back over 500,000 barrels per day to the market, which adds to oversupply concerns at this point. Despite this weak demand, the OPEC Plus group plans to increase output by 180,000 barrels per day in October. Now, this decision is raising concerns about oversupply in an already weak demand environment. The bearish outlook is very clearly reflected right now in market positioning. Speculative traders have increased short positions and reduced long positions to 52-week lows. This pessimistic sentiment is causing the market to ignore potentially bullish news such as tanker attacks in the Red Sea and lower OPEC production in August. This combination of weak demand, particularly from China, and the prospect of increasing supply is creating a bearish outlook for oil prices overall. The question now, though, is whether OPEC Plus will need to reconsider its production increase plans to prevent a growing supply glut. So let's begin with the story where I talk about consumption in India. Look, the government recently released the economic data for the first quarter of this financial year, and there are some very interesting trends. Real GDP growth came in at 6.7%, which was much less than the RBI forecast of 7.1%. The GDP growth in the preceding quarter was about 7.8%. Now, of course, the reason for this was elections and heat waves, which we have spoken about quite a bit in the previous episodes. Both of these factors had a disruptive effect on economic activity, ranging from construction, agriculture to consumption. Look, private final consumption expenditure is just a fancy word of talking about the money that households spends on goods and services for their own use. This gives you a sense of consumer confidence and if consumption is strong. Gross fixed capital formation refers to the investment in physical assets like building, machinery, and infrastructure that businesses and governments make. This tells you whether businesses are confident enough to invest in their businesses. Now, with that context out of the way, let me explain what is exactly happening. I'll start with private consumption first. Look, private consumption is about 60% of our GDP. This means if households are not spending, it'll have a huge effect on GDP growth. Now, since the financial year 2020, consumption growth has been very weak if you exclude the COVID drop and the recovery. This is because COVID was a very huge shock that affected not just incomes, but also spending patterns. In fact, it is not even clear yet if people have psychologically recovered from the massive COVID shock. Now, this was followed by the massive inflationary shock, especially food inflation, which further affected household spending. This is because now most of the money was going towards things like fuel, energy, and food because prices were so high. Then there were also higher EMIs because interest rates went up. Now, if that was not bad enough, the rural economy was hit with poor poor monsoons, and brutal heat waves, which further complicated things. So, the last 3 to 4 years, so to speak, have been a case of when it rains, it pours. Now, you might be wondering, if households were in such a bad shape and not spending, how is the Indian economy even growing at 7 to 8%? Look, that is because over the last couple of years or so, the government has been making significant investments, and this has largely been responsible for good GDP numbers we have seen. But the previous quarter that we saw coincided with the elections, so there was almost no government spending. This means private consumption and private investments had to do the heavy lifting all by themselves. I'll get to private investments later, but in the last quarter, private consumption grew by 7.4%, which is the highest in the last 7 quarters. Now, this is good news because it is not possible to achieve durable economic growth if households are not spending. The government cannot continue spending forever and juicing up our GDP numbers. So, this begs the question, will consumption growth remain strong? Well, the good news is that there are signs that the rural economy is now doing well. Two-wheeler and tractor sales, which are often used as leading indicator of rural demand, have been doing very well as compared to passenger vehicles. Also, people enrolling in the Mahatma Gandhi National Rural Employment Guarantee or Manrega scheme have been falling consistently. The other positive is that monsoons have been really good and sowing has been good so far as well. Also, in the recently concluded results season, pretty much all FMCG companies were upbeat about rural demand. Food inflation also seems to be under control, and RBI is bound to start cutting rates in the next couple of meetings. But the bad news here is that urban consumption seems to be falling. So the question is, if one falls and the other goes up, will the effects more or less cancel each other out? The other big factor is that the global economy is also now slowing down, which is a further headwind for the Indian economy. We are already seeing the sharp fall in the growth of China, which is a big engine of global growth. US is also expected to slow down. Now, as I mentioned earlier, I'll get to the gross fixed capital formation or investment growth, which is an indicator of whether businesses are feeling confident and making new investments. This number grew at a great rate of about 7.5% in Q1 as compared to 6.5% in the previous quarter. This is despite the fact that there were elections and heat waves. This means private companies seem to be confident into investing in India. Now, if you remember, in some of our previous episodes, I had also spoken about how investment growth had also been a problem. Indian companies were simply not investing enough, but it looks like that is turning a corner now. So now the question is, will India be able to grow at 7%? The odds seem to be stacked against India, but it's not quite impossible. There were some green signals in Q1, but the question is whether it was just a one-off quarter or the start of a larger trend. Let's talk about auto manufacturers versus auto dealers. Look, selling automobiles is a very tricky business. One element that makes it really tricky is inventory management, which in very simple words is the number of vehicles stored in a warehouse and are ready to be sold. Inventory optimization is very crucial because automobile dealers and manufacturers need to pay a hefty amount for storage space. They also incur costs to finance these vehicles sitting in their warehouses before they are sold, and needless to say, there is also depreciation on the vehicles lying around unsold. Today, India's automobile industry is struggling with a very high inventory problem. There is high stock and low demand. Passenger vehicle sales are expected to fall by 6 to 8% year on year, according to an estimate by Motilal Oswal. Excluding two-wheelers, sales remain weak across the board. Strangely and funnily though, the severity of this inventory problem is being debated between auto manufacturers and auto dealers. The Federation of Automobile Dealers Association, or FADA, says that the current automobile inventory is about 70 days, which by the way is pretty high. On the other hand, the Society of Indian Automobile Manufacturers, or SIAM, estimates this number to be just 38 days. Now, who's wrong here and who's right is very difficult to predict. The reason why there is such a stark difference between these inventory estimates is because both associations calculate this inventory number very differently. Automobile manufacturers calculate by counting the number of cars they make, while on the other hand, auto dealers count it by using sales data and registration information. Now, ideally speaking, these numbers should still be similar, but that is not quite the case. My personal guess is that auto manufacturers are trying to downplay the number to keep the market sentiment positive, while dealers are amplifying it in order to safeguard themselves from being forced to take on more vehicles than what they can sell. But like I said, who's right and who's wrong is very difficult to judge. What is very well known though is that irrespective of the real number, there is an inventory problem in the automobile sector today. Take for example Mahindra and Mahindra. In their April con call, they said that the waiting period for some of their models was more than 2 to 3 months. But if you look at the reality today, this waiting period has come down to as low as 2 to 3 days. To clear up inventory and promote sales today, automobile companies and dealers are offering deep discounts and schemes to the extent that they would normally never would. For Maruti, discounts have declined 10% month on month for the Arena channel, but have increased 5 to 7% month on month for the Nexa channel. Tata went on to increase its discounts to 20,000 rupees from 10,000 rupees last month on its best-selling compact SUV, the Punch. Tata's other model, Nexon, continues to see a discount of up to 1 lakh rupee on some of its variants, according to the same Motilal report that I referred to earlier. From the dealer's perspectives, though, it makes a lot of sense. If you assume there are about 7 lakh unsold cars lying around, dealers are losing crores per month just to hold them in their warehouses. By any stretch of imagination, that is a lot of money to lose, and hence deep discounting does make sense. But that said, it is not like dealers cannot hold inventory. As an industry practice, most dealers can sustainably hold inventories of 30 to 45 days around the festive season, like the one we are heading into now, and that is because they anticipate great sales during this time. But this year, inventory levels have exceeded 2.5 to 3 months, which, as I explained earlier, is causing a lot of problems. As a proposed solution, the FADA or the Dealers Association has written to SIAM or the Manufacturers Association twice in the last 2 months. Their ask is that automakers reduce the number of vehicles they send to dealerships in order to align with weak demand. In addition, the FADA is also pushing for the continuation of the FAME 3 policy to boost demand for EVs. FAME policies, by the way, are subsidies and incentives provided by the Government of India to promote the adoption of EVs in the country. The FADA is also calling for a reduction in GST on entry-level passenger cars and two-wheelers from the current rate of 28% in order to make these vehicles more accessible. Until then, though, the automotive industry is hopeful that the festive season will bring some relief to the current low demand situation. It'll be very interesting to see how this sector shapes up and deals with the problem over the next few months or so. I'll cover this further as and when there are more updates. Look, as you might already know, Reliance is one of India's largest industrial conglomerates. It has a market cap of over 20 lakh crore rupees and they hold about 9% weightage in Nifty 50. The company's business is incredibly vast. They span oil and gas to retail, telecommunications, and even new energy. Across all its businesses, Reliance had 9.3 lakh crore rupees in sales and 77,000 crore rupees in profits last year. Reliance's massive size and just presence means that any change in its business has a ripple effect across the entire Indian economy. They recently did an annual general meeting or AGM, and there were some very interesting insights that I would like to talk to you about. Let's dive into each segment and highlight the key points from the AGM. Let's start with oil to chemicals or O2C, which is Reliance's most profitable business. The O2C segment this year as well remains the biggest revenue generator, but it is adapting to a changing world. Oil producers and refiners are operating in a world where they are coming under pressure to reduce emissions by moving away from fossil fuel-based activities. Government-owned refiners like Indian Oil, Bharat Petroleum and Hindustan Petroleum are making significant investments in petrochemicals to move away from low-margin oil refining business, and Reliance also seems to be following the same path. The company processed 60 variants of crude oil last year at a time when crude prices have been incredibly volatile. Reliance is expanding into specialty chemicals like PVC, which are crucial for India's growing construction sector. This also aligns with the government's focus on self-sustainability and infrastructure development. Very visibly, sustainability is becoming a core focus for Reliance. Reliance now recycles 2 billion plastic bottles annually, aiming for 5 billion next year. And despite global pressure to reduce fossil fuel use, Reliance is finding ways to make its O2C business relevant for the future. This includes investing in advanced technologies and exploring more efficient production methods. Moving on, let's talk about Reliance Retail, which is operating in a very interesting environment. On one hand, you have a rising class of mass affluent Indians with the ability to spend. This is accompanied by the trend of premiumization and rapid penetration of digital payments. And on the other hand, there is the rise of quick commerce and the promise of instant convenience. Coincidentally, Reliance Retail is also dipping its toes now in quick commerce. It is in this very environment that Reliance Retail is operating 18,000 physical stores. Also, Reliance is entering the jewelry segment now, which very recently Birla entered with Indriya. Reliance is also looking to blend online and offline shopping experiences very similar to Amazon's approach. But they're doing this with a vast network of physical stores. By partnering with 4 million small shops, Reliance is turning potential competitors into their allies. The main big highlight over here was that they aim to double their revenue in the next 3 to 4 years. This means they have very aggressive expansion plans. Moving on, let's talk about Reliance's digital services and Jio. Look, the Indian telecom sector has undergone a massive shift in the past decade, and this is largely due to the disruptive entry of Reliance Jio in 2016, where they offered dirt cheap 4G data plans. For your context, in 2018, Vodafone was the market leader and they commanded a 35 to 40% share in mobile subscribers. But fast forward to today, Vodafone's market share has absolutely plummeted and it is less than 20% today, all thanks to Jio. After years of intense competition and massive investments in infrastructure, particularly 5G networks, telecom operators are now focusing on increasing their profitability. Reliance Jio recently took the lead in increasing tariffs. Vodafone and Airtel also quickly followed and they signaled a wide industry shift towards boosting average revenue per user or ARPU. Just last month, ratings agency CRISIL projected that the ARPU of the industry is set to reach 225 rupees from the current 182 rupees. Now, higher ARPUs are very crucial for recovering and sustaining the massive investments that are required for expanding and upgrading network infrastructure, especially as India races to roll out their 5G services nationwide. Reliance has also now transformed from a disruptive telecom upstart to a comprehensive digital services provider with ambitions that extend far beyond traditional telecom services. Coming to the highlights, Jio now has 490 million subscribers with its network handling 8% of global internet traffic. The company also completed India's fastest 5G rollout with 130 million 5G users already. Also, recent tariff increases aim to boost average revenue per user, as I already mentioned, which is a very key metric for telecom profitability. Also, Jio is now looking to expand beyond mobile services into the home broadband and business solution space as well. Reliance also in this AGM introduced something called the Jio Brain, which shows Jio's ambition to be a leader in AI services, not just a network provider. Moving on to the new energy segment of Reliance's business, as the world tries to move away from fossil fuels towards more sustainable forms of energy, Reliance also does not want to be left far behind. There is a global push for cleaner and more renewable energy sources, and Reliance is very much there. And to make use of this big opportunity, Reliance is now making a bold move into the renewable energy sector. Even Adani's company, which is another major Indian conglomerate, has entered this sector and established significant presence in solar and wind. Now, as per Reliance's big move in renewable energy, they plan to start making solar panels this year, reducing India's reliance on imports specifically from China. We spoke about in one of our episodes titled "Why is China dumping everything everywhere?" Also, a large battery factory is being built which could support India's electric vehicle ambitions. Right now, China has pretty much the entire battery market and they produce more than 75% of the world's EV batteries. Reliance is also investing in green hydrogen, which is seen as a potential replacement for fossil fuels in industries like steel making. Reliance aims for this new segment to match its oil business and profitability within just the next 5 to 7 years, which is a very, very ambitious goal. Moving on, let's talk about the oil and gas exploration and production industry of Reliance. Look, while this is currently very small, this segment is growing significantly. Reliance's KG D6 field or Krishna Godavari Dhirubhai 6 is a deep water natural gas field located off the eastern coast of India in the Bay of Bengal. This now produces 30% of India's natural gas. This means Reliance has become a major player in domestic energy production, which enhances India's energy security and reduces dependency on gas imports. Reliance is also now using new drilling techniques in order to extract more gas, which potentially could unlock more domestic energy sources. Let's talk about if the IPO gold rush in India is over. Look, the IPO markets have been red hot over the last 3 to 4 years and have followed pretty much the same trend as Nifty. After COVID, as Nifty rebounded from lows thanks to the bullish sentiment, private companies lined up to go public and the result was an IPO rush. From financial year 2020 to 2021, companies have raised over 3 lakh crores in IPOs. That is a huge number, and a good chunk of the IPO market craziness is because of the spectacular increase in retail investor interest. Now, I'm guessing you'd probably be curious over here about the investor behavior of IPO investors. Up until now, we did not have any data on this, but SEBI recently published a study to analyze investor behavior in IPOs. The study had some very fascinating insights, so let me give you some quick highlights. Now, look, even though for the longest time, market experts have advised caution before blindly applying for IPOs, the real truth is that IPO investors have done well for themselves in the recent years. The market has seen such a crazy bull run that it would have been nearly impossible to lose money in the last 4 years if you had participated in all IPOs and if you had received an allotment in all of them. But the problem is that people often overlook the fact that there is a much higher chance of getting an allotment in an underperforming IPO versus getting one in an IPO that is expected to do well. So the truth is that unless you were allotted shares in every single IPO, the high percentage of positive listings would not necessarily ensure that you made a net profit. Now, according to the SEBI study, 42.7% of all retail allotments were sold within just 1 week. HNIs and corporates exited 63.3% of their shares, and banks sold 79.8% of their shares within just 1 week of listing. But mutual funds, on the other hand, behaved a little differently and sold only 3.3% of their allotted shares in the first week. Now, this behavior, of course, varied slightly depending on IPO performance as well. But investors have also been more likely to sell IPO shares that showed positive listing gains, which is unsurprising. But to contextualize this for you, when returns were over 20%, individual investors sold about 67% of their shares by value within a week. And this is compared to just 23% when returns were negative. Now, some experts had been speculating that new investors who opened accounts after COVID-19 opened them only for applying into IPOs. The SEBI study also supports this. Nearly half the demat accounts used to apply for IPOs between April 2021 and December 2023 were opened after the pandemic. Earlier, high net worth individuals or HNIs could take massive loans from NBFCs in order to apply for IPOs. Shares were allocated to HNIs on a pro rata basis, which means they received shares in proportion to their application size, and this benefited those who bid larger amounts. But starting from April 2022, the RBI imposed a 1 crore rupee cap on such loans for HNIs. In addition, SEBI also changed the share allocation method from pro rata to a lottery system, which is similar to the one used for retail investors. Unlike the pro rata system, the lottery system randomly assigns shares and reduces the unfair advantages that HNIs used to enjoy earlier. Now, the result of this change has been quite positive. It has largely become less advantageous to apply for IPOs with large sums of money. This has led to fewer big-ticket, non-institutional investors participating and lower oversubscription rates. To contextualize again, the oversubscription rates in the non-institutional investor category dropped from 38 times to 17 times. Also, the exit rate of these investors within a week, which was SEBI's biggest concern by the way, dropped from 70% in 2021-22 to 25% in 2022-23. So overall, the regulators have successfully balanced market excitement with more well-judged investing practices, and this is great for our markets. And yes, I know many of these findings were probably very obvious to us, but we did not have data to back them up, which we now do, and that's great news. That's all the news and stories I have for you today. I hope you found value in this episode. I'll see you tomorrow. Take care and goodbye.